Now when the markets go down, bearish option strategies can be a great idea to balance your portfolio. These strategies, which may involve buying options or using spreads, limit the risk while maximizing the potential gains. In a bear market, this could be your best option strategy for turning falling prices into profit opportunities. Some popular bearish option strategies. Now, bearish option strategies expect a fall in the asset price. It is essential to determine how much and in what time frame the underlying price will fall in order to choose the best option strategies. Buying vanilla put options is the most simple and effective strategy. It gains benefit from the fall in the underlying as the risk is limited to the option premiums you pay, and the profit is unlimited to the downsides the stock may offer. But this strategy is all about timing the stock and catching the price momentum with special emphasis on anticipating the target and the time to reach it. Now, the downsides are that you'll always be subject to the negative effects of time decay and run the risk that the contract you buy will expire worthless and lose your entire investment. Now, consider an example. Suppose Nifty is trading at 24,120, which it closed today. If you are buying a vanilla put, you would be buying the monthly 29th August 24,000 put at the premium of 191. Now, if there is a fall directionally from the day you buy the option, your options, the puts which you bought, are going to multiply, and the maximum risk you face in this strategy is only to the extent of the premium you pay, that is the cost of 195 which you paid when you bought the 24,000 put. However, if the market is moderately bearish and you are not sure on the timing, the momentum, but clear on the view, and believe the premium you are paying at the current levels are expensive, one can opt for the bear put strategy. A bear put strategy comprises one leg of the at the money strike of the put which you buy, and you also short simultaneously one put of a lower strike price. Now both the options have the same underlining and the same expiration date. A bear put spread is set up for a net debit or a net cost, and the profits as the price of the underlying stock falls. If the stock price falls below the price of the short put, the profit is limited, as the potential loss is limited if the stock price rises above the strike price of the ATM long put. Now let me simplify this with an example. Nifty current market price 24,120. Now to set a bear put spread, you would buy Nifty 29th August, which is a monthly expiry. At the money strike would be 24,100 put, which is trading at a premium of 227. Now simultaneously you will be selling a deep out of the money put of 23,600 strike, which is quoting at a premium of 93. Now the net cost in setting up this strategy is the cost of buying the put, which is 227, minus the 23,600 put which you sold at 93. So net cost of this strategy is 134 points. The break even of this strategy would be 23,950. That's the level on basis of Nifty spot, assuming the expiry is on 29th of August. So if we expire at exactly at 23,950, that's our break-even point. The maximum fixed profit would be approximately rupees 9,000 in this strategy, and the loss in this strategy would be limited since we are also shorting a put. Now consider a second case of a bearish strategy. This is more a milder version. It is shorting a call, directly shorting a call, which is a moderately bearish strategy. Now when you short a call, it means that a trader is ready to sell an underlying asset at a calculated price in the future date. You benefit only to the extent of the credit of the premium sold. Now the benefits arise if the stock stays at or below the strike price where you sold. The risk is high as the losses can be unlimited and mount up if the prices go against you. Plus the margins required too are hefty and almost equivalent to the futures margin if you would have traded directly in the futures market. I'll simplify this with an example. Now if Nifty again is trading at 24,120, The example of selling a call would be, I'm expecting Nifty to stay at or below 24,500 for the entire month of August series. So I would sell a 24,500 call, which is quoting currently at a premium of 112. The maximum profit which I derive by setting up this simple selling call strategy is 112 points. The credit which I immediately receive on selling these calls, and the break even here would be 24,500 plus 112 points, which is roughly around 24,612. I would profit if Nifty stays at or below 24,500 till 29th of August, and worst case, if Nifty moves against me, it moves above 24,612, then that is the point from where my losses start to pile up and I risk an unlimited loss situation. Now the last strategy, that's the bear call spread. Again, this is a moderately bearish strategy, and traders can construct a bear call spread by selling a call and simultaneously buying a higher strike call in the same expiration. The bear call spread is a high probability trade because it will profit if the underlying stocks moves down or doesn't move it much at all and stays below the strike where you sell the call. Now, since the bear call benefits from theta decay, traders will make money even if the stock stays sideways after the trade is placed. The best part is you receive an upfront payment or credit when you begin this strategy. Now I will simplify this with an example. Nifty is trading at 24,120. How do you set a bear call spread? I would sell a 29th August 24,500 call, which is trading at a premium of 112. Simultaneously, I will buy an out of the money call, 24,800 call, which is quoting at a premium of 45. Now, executing both these legs together, I get an inflow of 67 points. Possible break-even in this strategy would be at a level of 24,550. The maximum profit potential on this strategy would be limited to 67 points. Now, the potential profit is limited to the net premium received less the commissions, and this profit is realized if the stock price is at or below the strike of the short call at expiration, and the out of the money call which we bought expires worthless. So these are some of the simple strategies we have discussed to face bearish market situations. I hope this was insightful.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.